Growth companies generally don't have a lot of profits, if any. These are companies that are working to grow as big as possible, as fast as possible, so they're taking their profits and reinvesting it back into the company, which means there's more risk for more potential return. And that means there's a chance that the companies inside of these funds can go bankrupt a whole lot faster, but if it goes well, those companies can also grow a whole lot more faster. So growth funds are more risky for more potential, keyword potential return. A couple options here are QQQ and VUG. QQQ gives the exposure to the NASDAQ. You may have heard that term before. The NASDAQ is a group of the 100 largest companies in the stock market that are not financial. That's the key, not financial. That means most of the companies in the NASDAQ are actually tech companies, and these are a lot of companies that are innovating, trying to grow bigger, trying to go faster because they're innovating on the tech side of things. Then we have VUG. This is created by Vanguard, and this is a growth fund that's investing in those types of growth, startup-y type of companies. So these growth funds, these growth stocks are more risky, more speculative, for more potential return. And then we have the S&P 500 and dividends, which are a little bit more on the safer side. And this is why I say personal finance is personal because, well, your goals are going to be different than somebody else's. Some of you might hate dividends, some of you might love dividends, some of you might want more risk, some of you might want less risk. And this, I'm going to give you one more bonus. This is a bonus ETF that you can consider investing in for those of you that believe in a particular niche. The nice thing about ETFs is there's an ETF for almost anything. So if you believe in a particular industry, if you believe the markets are shifting towards one particular direction, that can create an investment opportunity. But if you don't know which company to invest in that shift, well, you can just invest in a fund that gives you exposure to the broad shift. I'll give you an example. BOTZ, bots. This is an ETF that gives you exposure to AI and robotics. So if that's something that you believe in for the next 5, 10, 20 years, you don't have to find the perfect company. There are ETFs that give you exposure to that. Another example is AGNG, aging. There is a growing demographic of older people in America who are, well, getting older. And those older people are going to need different services, different healthcare, different needs. This ETF invests in those companies that service older people. So essentially it profits off of people becoming older. If you believe that's a shift that's going to become more profitable in the future, that's something that you can consider investing in. IYG. This is an ETF that gives you exposure to financial services. So if you believe in the future of banking and financial services, well, this is an ETF that can give you exposure to that. The reason why I'm showing you this is there are ETFs for anything. So if you want to invest in an area where you believe money is moving, well, that doesn't mean that you can't do it if you want to invest in ETFs. In fact, there's ETFs for pretty much anything that you can imagine, and this can give you the opportunity to diversify within that niche as well. But this is where you have to kind of know how you're going to allocate your money, because the reality is this niche ETF is more risky, and you have to know how much risk you're willing to take on. Yeah, if you're 19 years old, you can take on more risk. As you get older, you might not want as much risk. You have to know your tolerance for risk, what type of returns you want, and are you willing to withstand the ups and the downs? Because the way that you win as an investor who's investing in ETFs is not to invest $10,000 today and then hope that this money becomes $1 million when you retire. That's not the way that you do it. The way that you win is by following a strategy that many people call DCA, dollar cost averaging. I like to call it ABB, always be buying. That means you set up a cadence that's consistent, passive, and automatic. CPA, consistent, passive, and automatic. Money is pulled out of your checking account and invested into your portfolio of ETFs, into your portfolio of funds, and you set it and forget it. Maybe it's once a week, maybe it's once every 2 weeks, maybe it's once every 4 weeks. You pick a cadence and you set it and forget it. For me, what I do is once a week. I do it on Wednesdays. There's no secret science as to why. It's just in the middle of the week. Every Wednesday, money is pulled out of my checkings account and is automatically invested into my portfolio of ETFs, no matter what. It doesn't matter if the markets are going up. It doesn't matter if the markets are going down. It doesn't matter if markets are crashing. It doesn't matter if markets are booming. It doesn't matter if we have a Republican in the White House. It doesn't matter if we have a Democrat in the White House. It doesn't matter what's happening. I just keep buying. And I want you to remember this, because anytime we start to see a downturn in the markets, I get the questions. Jaspreet, should I be selling everything right now? Should I stop buying? When in reality, the only time you might want to change your strategy is when you're going through a recession, when you're going through a downturn. maybe buy some more. Because remember, you have to be a long-term investor. You have to have at least 10 years, if not 20 or 30 or 40 years, to really see the growth, but at least 10 years. And if you have 10 years plus on your investment horizon, a recession doesn't change your investing plan. You just keep investing your money, and the only change you might want to make is potentially buy more. Because when markets go down, it gives you the opportunity to buy more good investments at a discounted price. When things go down, markets crash. We saw it happen multiple times in 2025. We saw it happen in 2022. We saw it happen in 2020. Well, that creates the opportunity for you to come in and buy good investments at a discounted price. Now, we don't know how long a downturn will last. We've seen more than one recession per decade for the last 100 years. In fact, we've seen 16 recessions over the last 100 years. We've seen 25 market crashes over the last 100 years. We're going to continue seeing it happen in the future. You want to use them as buying opportunities to buy good investments for the long term, but you have to know what it is that you want to invest in the first place. So if you're just getting started as an investor, you don't know how to research companies, you don't know how to study the financials, and if that's not something that you're interested in, that's okay. You don't have to. You can just get started by investing your money into the broad stock market. And then as you get more involved, more sophisticated, more educated, well, now you can start to see how involved you want to be with your investments, if you want to actually manage your investments yourself, or if it's okay with you just investing in funds. Nothing is wrong, nothing is right, you just have to get started. The reason why so many people don't build wealth isn't because they made the wrong investment, it's because they didn't invest their money in the first place. The key is to get started. As you get started, work to optimize from there. You're not going to be perfect in the beginning. You are going to make mistakes. You are going to lose money. Markets will go down and you will pick a bad investment. That's part of the game. Don't blindly trust what any random guy on YouTube says, because what's right for me is not going to be right for you. I just want you to start thinking like an investor, start putting your money to work, and then find the right investments for you and your family. That way you can build wealth for yourself as well. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.